Ladies and gentlemen, good day and welcome to the Q4 and FY 2023-24 earnings conference call of PNB Housing Finance Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Deepika Gupta Padi, Head Investor Relations and Treasury. Thank you, and over to you.
Thank you, Yashashri. Good evening and welcome everyone. We are here to discuss PNB Housing Finance Q4 and FY 23-24. You must have seen our business and financial numbers in the presentation and the press release shared with the Indian stock exchanges and also available on our website. With me, we have our entire management team across verticals, led by Mr. Girish Kousgi, our MD and CEO. We'll begin this call with the performance update by the Managing Director and CEO, followed by an interactive Q&A session. Please note, this call may contain forward-looking statements which exemplify our judgment and future expectations concerning the development of our business. These forward-looking statements involve risks and uncertainties that may cause actual developments and results to differ materially from our expectations. PNB Housing Finance undertakes no obligation to publicly revise any forward-looking statement to reflect future events or circumstances. A detailed disclaimer is on slide 33 of the investor presentation. With that, I'll now hand over the call to Mr. Girish Kousgi. Over to you, sir.
Good evening to all the investors. I'm happy to state that Q4 and FY24 performance has been very good. We had an exciting financial year whereby we made significant stride across parameters. That is growth, asset quality, liability mix, liquidity, credit rating, and profitability. At the start of the year, we raised capital. We did rights issue, which was subscribed by 1.21 times. In terms of growth, we had mentioned that we will get into double-digit growth on the retail front. We were able to show growth on a YOY of 14% on retail loan book. And this happens to be the highest growth in last 5 years. And also we moved largely towards retail. Now retail contributes to 97% of our portfolio. Within retail segment, we started affordable business. We started in last financial year and now it's 15 months. So in about 10 months time, we built a book of 1,000 crores. And as of March, the book is close to 1,800 crores. So March 24, the book was 1,790. So we had a very good story on affordable. We started off with 100 branches. We opened 60 branches in affordable between December to March. So now we have 160 branches, which will cater to affordable segment. And predominantly, affordable branches would be in tier 2 and tier 3 cities. This business, affordable business, contributed to about 12% of disbursements in Q4. It started with 3%. This was last year, Q4. That's when we started the business. So in about 5 quarters, from 3% incremental contribution, we have moved to 12% contribution. This is on disbursements. We also started a new vertical called emerging market, and this was keeping in mind that we had taken this call of transitioning this company within retail from prime-based business to affordable and emerging market. So we have started a new vertical starting this financial year, that is April 2024. We will have 50 branches in emerging segment, catering to a segment which can give us a higher yield. So our plan is to try and build the book from both affordable and emerging, which would contribute to almost about 40 to 42% of incremental business. So whatever business we're going to do this year, incrementally, affordable and emerging would contribute to 42% of the overall disbursement, and the rest 58% would come from prime. So as you speak, we have totally 300 branches. Out of 300, 160 would be affordable, 50 branches would be in emerging segment, and the balance 90 will cater to prime. In order to bring undivided focus on retail segment, we ensured that we set up different verticals. For example, affordable, emerging, and prime. These three are different verticals within retail, which means there is a dedicated team starting from sales, credit, operations, and collections. This is to ensure that we smoothly transition from prime to high yielding business, and that's the reason why we started both affordable and emerging. If we look at the total number of branches, we have 300. Almost 2/3 of the branches would be focusing on building book at a higher yield. In terms of overall loan book growth, on a YOY, we grew by 10.3%. Retail, we grew by 14.1%. On affordable, last year, the book was about 138 crores. And this year, as of March, the book is 1790 crores. We have grown by 11 times over last year. Corporate, the book last year was 3,800 crores, and this year it is 2,052. The book has degrown by 46% as per plan. And runoff last year, that is FY23, it was 18.7. We have a good story here. Runoff has come down to 16.7%. On the loan book, as I mentioned, on a YOY, we have grown by 10.3% and quarter on quarter by 4.8%. Retail loan book, we have grown by 14.1% on a YOY, and sequentially, the book has grown by 5.3%. Affordable book, on a quarter on quarter basis, we have grown by 56%. On a YOY, it's over 11 times. We are looking at a book growth of 17% in retail segment, FY25 onwards, with higher focus on affordable and emerging segment. Talking about disbursements, on disbursements, retail disbursements grew by 35% in Q4 and 19% in FY24. We disbursed loans worth 5,541 crores, which is again all-time high in last over 5 years. And if you have to look at the whole year, the disbursement was 17,483 crores. Out of this, 1,653 crores was from affordable segment, which is 10% of total retail disbursements. We started off the quarter with 3% contribution from affordable in the overall retail, and Q4 of last year, the contribution was 12%. For the whole year, the contribution is 10%. This percent is likely to go up to 18% in FY25. Out of the total disbursements, total retail disbursements, 86% is up to a loan of 1 CR. So the concentration is largely up to 1 CR, and up to 1 CR, the retail loans is about 86%. So it's only 14% which is more than 1 CR on the retail side. On the retail disbursements, YOY the growth was 18.5%. And if you have to talk about total disbursements, it is 17.5. That is including corporate and affordable. In terms of geographical breakup, North contributes to about 35.3%, West is about 27%, and South is 37.5%. On the asset quality, we had a great and remarkable improvement in asset quality. Our GNPA reduced by 57%. FY23, the GNPA was 3.83%, and FY24, that is as of March, it is 1.5%. Net NPA declined to less than 1%, so it is at 0.95% as on 31st March 24. We will continue to work towards achieving best-in-class asset quality in the years to come. Corporate GNPA, March 23 was 22.5%, March 24 is 3.31%. Retail GNPA as of March 23 was 2.57 and March 24 is 1.45. Overall GNPA at an enterprise level, March 23 was 3.83 and now it is 1.5%. And net NPA, March 23 was 2.76% and March 24 is 0.95%. On collections, we were pretty keen and focused on cash collections. On using various legal tools, we aggressively used surfacing and auction. We sold 268 properties in FY24 through auction as compared to 95 properties in FY23. And in FY24, on those 268 properties which went through auction, there was no principal loss at an enterprise level. As I had mentioned earlier as well, company had a written-off pool of around 1,700 crores in corporate and 500 crores in retail. In FY24, we have recovered about 100 crores from write-off pool. We continue to work on this recovery in write-off pool. On the corporate loan book reduced by 46% in FY24 and now the book is 2,052 crores. The reduction is on account of resolutions, balance transfer, accelerated prepayment, sale to ARC and runoff. In Q4, one account of pause of 126 crores slipped to stage 2. We are very confident that this account will be in stage 2 or might recover to stage 1, and we are very closely monitoring the corporate book. In terms of borrowing mix, we had a very good story. In FY24, we received 3,000 crores from NHB, which started in FY24, and it was not there in prior 2 to 3 years' time because of high GNPA and high net NPA. We started off in FY24, and we have availed 3,000 crores from NHB, which will come at approximately about 50 bps lower than the other average source of borrowing. We restarted raising funds from wholesale debt market. We raised about 1,500 crores through NCD and 10,000 crores via CPs in FY24. The incremental cost of borrowing for the quarter is 7.93. Deposit grew by 3% during the year with 88% as public deposits. We are well capitalized with CRAR of 29.3%. And out of that, Tier 1 is 27.9%. The mix for Q4, that is as of March 24, term loans is about 40%, deposits 32%, NCDs are about 10%, NHB refinance, which was 5.7% as of March 23, increased to 9.2%, CPs, which was nil in March 23, rose to 6% in March 24. ECB, which was 10.2% in March 23, came down to 2.6%. So three critical changes. One is on ECB. ECB came down, CPs went up, and NHB went up. As you are aware, we got rating upgrade from AA to AA+ from 3 rating agencies, that is India Ratings, ICRA, and CARE. We were also certified as Great Place to Work in October 23 by GPTW Institute. In terms of profitability, in FY24, PAT stood at 1,508 crores, registering a growth of 44% YOY. X one-off, PAT registered a growth of 79% YOY. Our efforts across parameters helped in improving the profitability. Our return on asset improved to 2.2% in FY24 from 1.61% in FY23. Return on equity was at 10.9%. In terms of guidance, margin would be around 3.5%. ROA will be more than 2.1%. Credit cost for FY25 is expected to be around 30 basis. I will now hand over to Vinay, CFO, to brief on the financial parameters.
Good evening to all the participants present on the call today. I am pleased to present an overview of our financial performance for Q4 FY24 and full year FY23-24. Happy to share that we have reported PAT of 439 crores in Q4 FY24, which is up 57% year-on-year and 30% quarter-on-quarter. For FY24, PAT grew by 44% to 1,508 crores. Ex one-offs in FY23, PAT grew by 79% year-on-year. In Q4 FY24, yield was 10.08 versus 10.19 in Q3 FY24. The marginal drop was due to repricing and runoff of high-yielding book during Q4. Yield for full year FY24 was at 10.35% versus 10.28% in FY23. However, X one-off yield in FY23 was 9.78. So there is a sequential improvement year-on-year. Cost of borrowing stood at 7.98% for Q4 versus 8.07 in Q3. X one-off, even Q3 was at 7.98. So we are flat on cost of borrowing. Full year cost of borrowing is also similar at around 8% versus 7.5 for FY22. Net interest income grew by 6% year-on-year for Q4 FY24. For full year FY24, net interest income grew by 7% to 2,500 crores. However, X one-off, net interest income grew by 22% year-on-year. NIM during Q4 was at 3.65%, which is in line with the last quarter X one-off NIM. The reported NIM last quarter was 3.49. Against that, in Q4 it is 3.65. Next year, we expect this to be somewhere around 3.5%. In Q4, OPEX grew by 23% year-on-year. However, this is largely on account of investments that we have made in Roshni vertical, IT transformation, and the new spend that has come on account of royalty. We have further invested in 90 additional branches for Roshni and emerging verticals in Q4 FY24. This will help us in scaling up Roshni and emerging verticals faster. Credit cost stood at 4 bps for Q4 and 25 bps for FY24. Happy to report that we have recovered around 49 crores from the return of pool during Q4, which helped in controlling credit cost for the quarter. Recovery for the full year was 99 crores. We will continue to optimize credit cost through recoveries from the return of pool. ROA last year was 1.6 and it has improved to 2.2% for the full year FY24. ROE stands at 10.9. Capital adequacy is at 29.26 as of 31st March with Tier 1 at 27.9. You may also refer to page 23 where we have put in X1 of financials for FY23-24 as well as the reported numbers. There are no one-offs in Q4 FY24. Thank you. I hand it over to Deepika.
So we can start with the Q&A, please.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take our first question from the line of Renish from ICICI. Please go ahead.
Yeah, hi. Just two questions from my side. One, on this new vertical, which is emerging market, what is the outstanding AUM stands at as of March 24?
So this is a new vertical. We have just started this year. What we did was we just culled out some of the existing prime branches depending on the geography and customer segments, which can give us an opportunity of building book at a higher yield. And we also opened a few new branches between December to March.
Okay. So as of now, there is...
So as of from the existing set of branches, the book is around 12,000 crores.
This year, 12,000 crores.
Yeah.
Okay. And secondly, on the affordable piece, when we look at the customer profile, it's a select customer at 62%. And when we look at the sourcing mix, it is almost 40% being sourced by the DSA route. So is there any CIBIL threshold limit we follow, or maybe if you can just throw some light on the customer profile under the affordable housing finance space?
In terms of threshold, in terms of what? I didn't understand you. CIBIL. Okay.
For people.
Yeah, fair enough. So we are now present in 3 segments out of 4 segments. The 3 segments are prime, emerging, and affordable. The only segment where we are not there is super prime, and that is more by design. In terms of affordable, we would be operating in geography in segments, where most of the affordable companies would operate. In terms of bureau, I think about 1/3 of the customers would be either new to bank or new to credit. And we would have close to about 45 to 50%, where the bureau score would be about 700 plus.
Okay. This is in the affordable segment, right?
This is in the affordable, yeah.
Got it. And just the last question from my side on the yields. So, adjusted for one-off, there has been a sharp decline in the yields, from 10.29 to 10.08 in Q4. So what is happening there on the yield side?
So basically, which is why I mentioned, I think if you see last few quarters, we had taken this transformational journey to move away from super prime to prime, and we started affordable about 50 months back. And this year we have taken a call to, further move some portion of business from prime to emerging. The reason why we are doing is that on the super prime and on prime, so definitely given the competition, and given that we are not a bank, we are an HFC, and definitely given a cost structure, there will be pressure on margins, and that is the reason we started moving towards high margin segments, and that is why this whole transition story. So there will be some pressure on the prime book in terms of book depletion, maybe because of foreclosure or maybe BT out. And that is why we had moved towards high yielding segments, affordable last year and emerging this year. So in terms of guidance, I think margin would be about 3.5%.
Got it. No, so just circling back to the yield side. I mean, when we look at the sequential drop in the yields, it essentially means that the disbursement yield under prime or super prime category is actually falling quarter by quarter because of the competition. Is that the right conclusion?
To a certain extent, yes, the answer is right. But to a large extent also, we are moving segments. And if you look at any organization, the portfolio yield would be higher than the incremental yield. So because of these two reasons, our yield would be lower if you look at quarter-on-quarter comparison.
Got it. But considering, let's say, the AUM mix changing competition on the super prime category plus maybe some lower cost of fund going ahead, we are fairly confident about sustaining NIM at 3.5%.
Yes.
Okay. Thank you and best of luck, sir.
Thank you.
Thank you. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Good evening, sir. Congratulations on good quarter. Sir, just kind of taking that discussion forward on yields before I ask the other two questions that I have. Very clearly you are saying that prime book will deplete, which is the lower yielding book, which will deplete. At the same time, our emerging vertical and the affordable book will increase, which is higher yielding book. So going forward, do you still see a pressure on yields as we move into FY25?
So if you look at last year, our corporate book has come down by almost half. So the book has come down by 47%. So obviously we are not doing corporate business now. We plan to start this year. So even that has contributed to drop in yields. And now the book has come down. Book is now down to almost about 2,050 crores, right? So if you see in comparison, compared to last year and this year, the contribution of yield contraction is largely because of a corporate book. So I was talking about retail. So even corporate book is one reason. So now the book has come down, and with change in our segment strategy and also the plan to start corporate this year, so we'll be back on the requisite yield to maintain a margin of 3.5%.
Got it. So, sir, essentially speaking, what you're saying is going forward, corporate book will also start growing. Anyways, retail is growing for us, and that can result in an improvement in yields.
Yes. So corporate, we have planned to start this year. Maybe we might start in second half. So that would also assist, in better yields.
Got it. Thank you. So one more question that I had was on the credit costs front. Obviously, this quarter the credit costs are very benign. But you have in your opening remarks guided for credit costs of 30 basis points. Just wanted to understand this write-off pool that you're carrying in both corporate and retail. When can it kind of start giving us recoveries like 50 crores, I think, what Vinesh also said in this quarter. So when can we expect higher quantum of recoveries, and over what time period can these recoveries come?
So I think there are two parts to this. One is this 30 bips is without considering write back, number one. Number two, write backs have started. So in Q4, as we mentioned that we did good amount of recovery. That has already started. It will continue, this year as well, quarter on quarter.
Good. And so just one last question. Again, circling back to OPEX. Very clearly we have invested in 90 additional branches for affordable and emerging. We also shared that we have now dedicated team of sales, credit operations and collections. I'm assuming across each of these three verticals. Then, from here on, do you expect the operating expenses, more particularly whichever way we want to look at it, OPEX to AUM or OPEX to assets, to increase over the next 2 years or so?
So OPEX, as you rightly mentioned, because we invested in new branches, both on affordable and emerging. Affordable 60 and emerging and bit of prime. We opened about 100 branches from December to March. So in that context, definitely yes, the OPEX is going to slightly go up. It will be in the range of 95 to 100 bits. That is OPEX to ATA. And if we look at the business, what we have done in FY24, that is from 200 branches. So starting this financial year, we will have 100 branches, which is ready and operational, which will start contributing business. So there will be some lag effect, but I think we should be able to catch up. and OpEx would be 95 to 100 bps.
Got it, sir. This is very useful. Again, thank you very much and all the very best to you and your team.
Thank you.